Hello students, welcome to my class. This is Professor Vincent Usaya, and this is part 2 of chapter 14 presentation, chapter 14 long-term liabilities. We left off with talking about some pertinent issues relative to valuation of bonds payable, and we talked about issuance and marketing of bonds to the public. At this point, let's take a look at the selling price of a bond issue, the situations that affect the selling price of the bond. Number one, we talk about supply and demand of buyers and sellers. That is applicable to anything from the standpoint of the demand and supply mechanism has a critical role to play with the price of any commodity. So we also talk about the relative risk of the bond also has something to do with the selling price. Market conditions, the state of the economy also is a factor. Investment community, we are told here, values a bond at the present value of its expected future cash flows, which consists of interest and principal. It's very important for you to understand this. What we are saying here is when the company issued bond or bonds, what you are doing is you are borrowing money from creditors. So you issue the bond to investors, those are bondholders, and you sold $100,000 worth of the bond. What you are doing is you are promising the creditor two things. Number one, you are going to pay the creditor principal at maturity, and number two, you are going to pay interest periodically, be it semi-annually or annually. So the two payments that the investor is going to receive from you are future amounts. So the question is, how do we determine the price of the bond? We said that the present value of these two different cash outflows in the future is the price of the bond. Remember, in intermediate accounting 1, we talked about present value, future value concept, okay? $1 today is worth more than $1 in the future. So we talked about all of that. So the present value, future value concept comes into play here. Essentially, we have to compute the present value of the two future cash flows to determine the price or the worth of the bond. So moving along, still talking about valuation of bond, where at this point in time it's very important for us to know the fact that when we talk about valuation of bond, another word for valuation is the price. Another word is the worth. So if you take a look at a lot of bond questions, some of the questions recurring on the CP examination, they will use these three words interchangeably. What is the value of the bond, or what is the price of the bond, or what is the worth of the bond? Now, so moving along, let's take a look at some important issues here in connection with the price or the worth of a bond. The interest rate. So we have two important interest rates relative to the value of a bond. Number one, we have the stated interest rate, meaning the rate that is stated on the face of the bond. So here is the bond, a piece of paper, and you have 10%, $10,000. This rate is stated on the face of the bond, so we call it a stated interest rate. Another name for it is coupon rate. Another name for it is nominal rate. Another name for it, which is not written here, is some people also call it face interest rate, meaning the interest rate that is stated on the face of the bond. Now, so the rate is written in the terms of the bond indenture, that is the agreement of the contract. Now, who the bond issuer, we said here, set this rate, that is the company issuing the bond or selling the bond. It is stated as a percentage of bond face value. What is the face value? Face value is the principal, or another name for it is par value. So one of the intricacies of this subject matter is the fact that one thing usually have different types of names. So we call this par value. Another name for it is the principal. Another name for it is face value. That means the value on the face of the bond. So the second important interest rate, because at the market rate or effective rate, the rate that provides an acceptable return commensurate with the issuer's risk. What does that mean? The market rate is the ongoing interest rate in the financial market. So we call it market interest rate, or we call it effective interest rate, or sometimes we call it a yield rate. Okay, these names are used interchangeably. So these two important rates are very significant in determining the value or the worth of a bond. Moving along, still talking about the valuation of bond payable. In other words, here we are talking about how do we calculate the price or the value or the worth of the bond. Now, we said that, one second. Here, the stated rate multiplied by the face value of the bond, all right? Now, this formula here is the calculation of the cash interest payment. So what does that mean? Give you an example. We have this bond, $10,000 is the par value for 5 years, 10% interest to be paid every year. So 10% of 10,000 will give you $1,000. So the interest that the bond issuer or the company that issued the bond is going to pay every year is 1,000. So how do we calculate that? It's very important for you to catch this. It is the stated interest rate multiplied by the par value or the face value. That is how we calculate the cash interest payment. Now, how do you calculate the amount of interest that is actually recorded as an interest expense by the issuer of the bond? This is just a different question. In other words, how do we calculate the interest expense? The interest expense and the actual cash interest payment could be two different things. Sometimes the same, sometimes not the same. So we are going to get into that eventually. But suffice it to say at this point in time, to calculate the interest expense, it is the market rate multiplied by the carrying value of the bond. I want you to make a note of this. The first one, in terms of the calculation of the actual cash interest payment, it is the stated interest rate multiplied by the par value. However, when we are calculating the interest expense, it is the market rate, this time, multiplied by the carrying value of the bond. We are going to talk about how to determine the carrying value of the bond eventually. So at this point in time, let us take a look at, still talking about valuation of bonds payable. It is actually important that you understand this concept, okay? Now, listen to this very carefully. Let's assume that our company decided to issue a bond, $10,000, all right? Interest rate is, give me a minute. The interest rate, the stated interest rate is 8% for 5 years, all right? So, what is the agreement here, or the contractual obligation between the bond issuer and the creditor? What the issuing company is saying is, I will pay the bondholder $10,000 in 5 years when the bond matures, and every year I will pay the creditor or the bondholder 8% interest every year. So that is what we are promising the bondholder. Now, take a look at this. Let's assume that the market interest rate is also 8%. Meaning, if the bondholder or investor go out to the financial market and buy a similar financial instrument with the same risk and whatnot, that investor is only going to be able to get 8% interest rate, and you are also promising to pay 8% interest rate. So the stated interest rate on the face of the bond and the commensurable interest rate in the financial market is also 8%. Therefore, you are going to set the bond at exactly $10,000. So the bond is going to be sold, or the bond is going to be valued at $10,000. So you are selling the bond exactly at par value, or the principal. So what do you have here? So every year you pay the bondholder 8% interest for 5 years, and at the end of 5 years you pay back the $10,000 principal. Now, let's take a look at this. Let's assume that 6 months later, you are still selling this bond to the general public. However, the market interest rate doesn't remain the same. The market interest rate goes up and down. It fluctuates. So 6 months later, guess what happens to market interest rate? The market interest rate went up by 2%. So the market interest rate is now 10%. You are still in the business of selling this bond in order for you to raise as much capital as possible. But here's the problem that you have. Now, when the investor comes, the investor said, well, of course, the investor is saying, well, I want to enjoy 10% interest rate, which is the prevailing market interest rate, but your bond indicates 8%. So the problem that you have is you cannot use a whiteout to get rid of 8% on the bond certificate. You can't do that because it is a legal document. But you still want to sell the bond nevertheless. So guess what you have to do? You are now being compelled to sell the $10,000 bond for less than $10,000 in order for you to make up for the 10% that the investor would have enjoyed in the market. So in such circumstance, I'm just making an assumption. I'm not actually doing the calculation in terms of the actual present value, future value. I'm not doing that. I'm just coming up with the numbers for illustration purposes. So now you are not going to sell the bond at, let's say, 8,000. Okay? So what happened here? You sold the bond for 8,000, but the face of the bond is 10,000. So you receive 8,000, and you are given a piece of paper with face value of 10,000. At the end of 5 years, guess what happened? You are going to pay back 10,000 to the bondholder, whereas you receive only 8,000. Wait a second. In addition to the interest rate that you are going to pay every year. So why are you willing to accept 8,000 and pay 10,000 at maturity date? You are willing to do that because the market interest rate is higher than your stated interest rate. So therefore, we say that when that is the case, the bond has to be sold at discount. In other words, you have to sell it less than the par value. In this case, you are selling it for 8,000. Unfortunately, our time is at this point, and we are going to start part 3 from this point.